Good morning, everyone, and thank you very much for joining me. This is the morning market review. It's Monday and it's the 2nd of October. My name is Russell Shaw. I'm a senior market specialist at FXCM, and my email address rshaw@fxcm.com. And of course, if you'd like to correspond, that's the email address to use. I'm just going to bring up our disclaimers, then we'll start off with the high risk investment warning. I'll keep this on screen for a few moments. Good morning, Kim. Thank you very much for joining. Pleasure to have you on the webinar. Hello, James. Hope you had a great weekend. Welcome. Let's just bring up our market commentaries disclaimer. Okay, and our reference is MarketScope 2.0 and TradingView. We'll start off with TradingView, taking a look at our real rate. And hey, Richard, good morning to you. Thank you very much for signing in, much appreciated. All right, here is the real rate. It is a key driver of the financial markets. It's tending to put pressure on the risk side of the market, and in contrast, it's driving money towards the dollar, which is regarded as the safe haven of choice at the moment. And you can see that it is still, if we zoom, it's still looking very strong. I'm going to change this to the daily in a moment, but I want to just show you that we are overbought on the weekly. And at some stage, this will resolve. It will normalize, okay? And keep that in the back of your mind. I think that is an important point, that we are due a normalization in the real yield on a weekly basis. So I think a significant correction here. Let's just take a look at the daily chart. Okay, and the daily chart still overbought as well. It did correct, but it's moved back into overbought territory. Again, I think that plays into that theme that perhaps we are due a correction. And I think that's important for us as traders, because the real rates being the key driver. So if we recognize the fact that there is some sort of potential dip happening here, how does it affect the instruments that we trade, right? That's going to be very interesting. Now, it's very difficult because we don't want to make any sort of predictions. We really want to react. That's the key. We want to react, but we want to have some sort of idea of what we're looking for, and then we can try and match the technical signals with those underlying fundamentals. And the markets tend to be forward-looking. So if the market is expecting some sort of pullback in terms of the real rate, then perhaps we'll see some, I mean, again, I don't want to predict, we want to react. Perhaps we'll see some froth come off the dollar, and perhaps we see those risk assets bouncing. And that's really what we're going to look at this morning. Just before we move across to looking at those instruments, let's take a look at the IEF. Just to reiterate what the IEF is. Here we're looking at yield. Okay, we're looking at yield. The IEF looks at bonds from a price point of view. It's an ETF looking at sort of the 7 to 10 year. So you just type in IEF. Okay, and you can see it's an iShares ETF. It's a bond ETF, 7 to 10 years. Let's just click on that. And what we want to see is, remember, yields are inversely related to price. So if yields are going to push down, then it would make sense for prices in the IEF to push up. Okay, so it does look like it seems to be bouncing from an oversold condition here. I'm still waiting for the technical signal. What's the technical signal? The trend following indicators crossing over, the green 5-day crossing above the orange 10-day. Let's just take a look at this on a weekly basis. Okay, still some sort of not some sort of, it's definitely in bearish mode. I think we would all agree it's in bearish mode. If we have to think about the overbought condition on the yield, perhaps then it's worth us just putting in the support here, and maybe the support here is going to push the bond prices up. If it pushes bond prices up, then we've got a reason to see the yields pushing down. There's no doubt, and we discussed this in a fair amount of detail last week, there's no doubt that bonds have been hit considerably hard. There must be some value in bonds. There must be. The question is, of course, what's the catalyst to get the bond prices moving? And there doesn't really seem to be a catalyst at the moment because we've still got that higher for longer theme. Okay, what was very interesting is the PCE number that came through on Friday. Let's just take a look at core PCE. PCE is the preferred gauge of inflation that is used by the Federal Reserve. That came through on Friday, and it actually came through softer than expected. In other words, heading towards that 2% target. So we'll just type in core PCE here. Okay, and what we're going to look at it, we're looking at it on an annual change. Let's just bring that up. And what I want to show you guys here, I think, is quite interesting. First of all, I like looking at this in a slightly different way. The RSR is insightful, but I like looking at it in terms of a rate of change. So I'm going to just take this RSR out, and I'm going to put in a rate of change. A rate of change is quite insightful here. I'll explain what I'm looking for. I'm looking at the 0. Anything below 0 is deceleration. Anything above 0 is acceleration, right? So we can take out the EMAs as well. And you can see that we are on the deceleration side of 0. That's encouraging. We're decelerating towards 2%. 2% is the Fed's target. Then what I did, I just want to make sure this is logarithmic. Let's just make this logarithmic. When you use trend lines, it's you must use the logarithmic setting because you're looking at it. Trend lines are effectively looking at gradient, so you want to look at it in terms of logarithmic. It's advisable, unless on very short term. Okay. What you can see is we've got the green gradient, which is measuring this peak with this peak, but then it shifts down to the orange gradient. So in other words, there's been an acceleration to the downside. Listen to me very carefully. There's a play on the words here get complex. It's an acceleration to the downside, which means it's an increase in the deceleration, right? So that's very positive in terms of what's happening with the core PCE. Headline PCE slightly different. Headline PCE takes in energy prices, and that's where the Fed's going to be, I think, a little worried. And what we can do is we can just bring up market scope finally. I'll just go through and bring up, let's just bring up UK oil, which is our CFD for Brent. And really, it's heading in this northeast direction. And I think that's, if we can see some sort of moderation in the oil price, that takes a lot of pressure off of the headline inflation. So the core number, which is really what the central banks can control, I think are looking pretty good. The headline inflation, that's affected heavily by the energy price, the oil price moving up. And we just want to see if there is any sort of pullback there. What's happening with the oil price is that it's being pushed up by OPEC Plus limiting supply. So it's basic demand and supply. They're making sure that they are contracting supply enough to create an excess demand to push price up. And you can see we've got the higher trough, higher peak. It looks as if this is the next higher trough in the series. Let's just keep an eye on that. Okay, if there's any questions, just go ahead and type those in. Let me just take a look. All right, we're going to look at the instruments that we trade now. We're going to start off with the US dollar. Now remember, we are looking at a potential pullback in the real rate. In other words, traders may be setting themselves up for a push down in US dollar and a push up in risk markets. And it does seem as if there is evidence in that particular line of thinking. If you take a look at last week's candlesticks, I'm just going to put an arrow in. So I'm looking at this candlestick. What type of a candlestick do we have? We have sort of an inverse hammer, don't we? What type of a signal does an inverse hammer gives us? And it gives us that there's some sort of selling pressure. So let's just examine that in a little bit more detail. And the way we'll do that, we'll put axes on. Okay, so we've got our set of axes, and the x-axis is really just Monday through to Friday. And what happened is that we opened, we dipped. That's where we got the low. We pushed up. That's where we get the high. At this stage, if I had to say, okay, guys, who's in control here? You would say the bulls are in control. And then what happened towards the end of the week when we saw the PCE inflation came in, we headed down like that. And if I said to you guys, okay, who's in control at the end of the week? Well, it's not an absolute bearish control. The bears have by and large faded the move by the bulls. So there is some bearish strength towards the end of the week. And that seems to me to indicate that perhaps the market is looking to set itself up for a potential dip in the real rate. Why a dip in the real rate? It's really frothy at the moment. We've seen is really frothy at the moment. Okay, what does everyone understand that? What would be interesting is if we got a reference candle here. Okay, in other words, it closed below last week's low. Very interesting. Let's just take a look at the daily chart here. Before we take a look at the daily chart, one other thing I wanted to show you guys. We're going back to the weekly. Let's just get rid of these. Okay, what I want to do now is I want to combine last week's candle with the candle from 2 weeks ago, from the week before last week. Okay, I want to combine this candle. I want to combine it with this candle, and what we're going to get is a very interesting candle. We'll get something like, looks like this. We'll take the range of those two candles. So there's the range, and then what you would do is you would take the open, and you would take the close, and you get something like this. So what kind of a, let's just make this a candlestick. So what kind of a candle is this? This is what we call a spinning top. So over the last 2 weeks, there's been a spinning top. Spinning top, typical candle of uncertainty. Why would there be uncertainty coming into the market now? Because I think we might be overdone on the yield side. When I say overdone, I don't necessarily, I'm not talking about a trend change here, but I am thinking about we looking at perhaps corrective action, and maybe it's worth trying to exploit that. let's just keep an eye on the daily. Okay, so the daily chart here, it's still in zone one. Zone one would be the zone of strength. If it crosses below into zone two, that's relative weakness, isn't it? That would be relative weakness. So a movement from zone one into zone two would probably be in line with this sort of hypothesis that we're starting to paint, and we would need to see some sort of bearish crossovers here. Let's just clean this all up. So there need to be some sort of bearish crossover. So maybe a bearish crossover there, a bearish crossover there. And even if we get the two triggers, it's not really going to pan out unless we get a push towards that lower quintile and we hold. Okay, it's very speculative now. Let's just see if we get those crossovers and if we start getting the angle and separation towards the downside. Keep an eye on the real yield as well. We want to see that real yield starting to normalize. Okay. All right. At the same time, so we've looked at the sort of haven side of things. Let's just take a look at the risk side of things. So we'll go through to the NASDAQ. We'll use the NASDAQ as our proxy for risk. Okay. And whilst we do have a lower peak, lower trough, we are at this support area. I just wonder if we get a boost here because of the overshot yields. In other words, do we get the NASDAQ charting a bullish reference candle here? You can already see the RSI starting to pop above 50, okay, and it's now challenging zone 3 going into zone 2. So that would be relative strength for it. So perhaps we get the risk market starting to position itself for a pullback in yield. Well, we'll go down to the hourly. Okay, we really need to see the stochastic move into the upper quintile and hold. If it moves into the upper quintile and holds, then we probably get a fairly decent swing, something like this. Okay, so that's kind of starting off with a hypothesis. The hypothesis is that real rates seem a little bit frothy at the moment. If they're going to pull back, how does that feel? How does that feed into the risk side of the market? How does it feed into the haven side of the market? So that's what we're going to be watching for. So do we hold back on US dollar pairs for this week? I wouldn't necessarily say hold back. Again, you know, look for the crossovers. The idea here is to use your money management. I always reference, what does your trading plan say? You've got to go back to your trading plan. I can't outright give advice, just not licensed to do that. But the idea here is if there is going to be some sort of movement on the real rate, it's probably worth exploiting that if the signals are given. If the signals are given. Are there any other questions there? What is the real yield? What is the real yield ticker? All right, so what you want to do is you want to go through and you want to type in US 10-year minus the, just type in break even here, and then you'll choose the 10-year break even, and that's the real yield. Okay. For the real yield, don't look at that on logarithmic. Okay, just make sure that's on regular, and you can monitor it that way. Yeah. So Gurdeep saying, are we trading against the trend? In this case, possibly. In this case, possibly. There's two ways to basically approach this, Gurdeep. Either you wait for the dip, okay, go in with the trend, or you fade the overbought condition. Okay. It looks to me as if the real rate may be overbought. Again, I don't want to suggest, I don't want to predict that. I really want to wait for the signals to manifest. But I do think that we are at a stage where those real rates do seem a little elevated for now, particularly particularly after the PCE numbers that came through on Friday. I hope that answers the question there, Gurdeep. Any other questions? I think just before we sign off, let's take a look and see what's happening on the DAX, which is a difficult chart at the moment. Again, lower peak, lower trough. It's looking like it's pushing down. We're in zone 3. Okay, and what I would do is I would wait to see if the real rate has any sort of influence on this. Is there a crossover, and is there a angle in separation? Are we moving towards the lower quintile? As Gurdeep says, this is a counter trend analysis, so just be aware of that. When in doubt, just default back to your trading plan and apply your trading plan rules. All right, I don't see any other comments at the moment, so let's wrap up here. I want to wish you guys a great day ahead, a great evening. We shall chat again tomorrow, and we will see how this hypothesis, this theory unfolds over the next few days. Thanks very much, guys.